All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. So today is Thursday. It is approximately 1:01 p.m. Eastern Standard Time. It's April the 13th. I just want to walk you guys through a trade that I'm currently in. So I actually put this trade on. So I put the credit spread on the put side on yesterday. So as the market began to tumble late in the afternoon yesterday, I decided that it would probably be beneficial to put on a vertical put credit spread, considering that I was anticipating that the producer price index number would actually be positive this morning. It came out this morning at 8:30 a.m. And as a result of that number being positive, it would actually cause the market to bounce. And it did exactly that this morning. The market actually bounced. And so when the market closed yesterday, the price was, the price close of yesterday was 41.08. Right, so we look at that on the, so 41.08 is roughly, somewhere around here. So that's where the market was, that's where it closed at. And as you can see here, my position that I put on is far away from the price of the underlying, which is SPX. And so again, as I mentioned, I knew that the PPI number was coming out this morning, and so I figured that the price of the underlying of SPX would actually bounce, considering that the CPI number this past Wednesday, today Thursday, this past Tuesday, they come out Tuesday or Wednesday? Wednesday. It came out Wednesday morning. So the CPI number came out Wednesday morning. That was positive. So it's showing that inflation is actually cooling, right? And so, basically the idea is that the interest rate hikes from the Fed is actually doing its job, right? So it's actually causing the CPI number to come down, to contract, and as a result, I thought that the PPI number would actually have pulled back as well when it came out this morning. So it did, and so I could have actually closed this trade out this morning, but I decided that I'm going to keep it on and let it expire worthless. And I wanted to add credit to the position by putting on a vertical put credit spread, right? Basically mimicking the vertical put credit spread. So put on a vertical call credit spread that mimics the vertical put credit spread, and that it's a $10 wide, and also I'm selling the same number of contracts, right? So essentially turning my vertical put credit spread into an iron condor and taking in additional credit without having any extra buying power required. So I don't have to spend any more money or put any money out. There's no additional capital that's required to put on the additional vertical call credit spread if it's identical to your vertical put credit spread, right? So the position credit is $300, and as you can see here, I've made 43% of that thus far, which is roughly 46%. It's oscillating. So 130, 140 bucks I have made unrealized at the moment. But nevertheless, so I suspect that I'll be walking away with the entire 300. As you guys know, I like to get between $300 to $500 per day. Sometimes I get more, and sometimes I get less, but the goal is always between $300 and $500. Now, the reason why I selected the 41.45 on the call side is because that's actually beyond my 1% price level, right? So if you guys have been following my videos, you know that I put these percent levels on my chart every day, and ideally I would like to be beyond the 2% mark on the upside or on the downside, and that's just based upon the research I have done over the last 20 years. And if you're not familiar with the research that I'm speaking of, there's a link down to the video where I discuss these percent levels and how they have been derived, if you will, right? And so my strike price on the call side is at, as you can see here, I have it marked off, is at 41.45. So it's slightly beyond that 1% move to the upside. And if we look at my spreadsheet here, so the 1% move to the upside is essentially 41.40. Yeah, 41.41 and some change, right? So considering my position is at 41.45, it's a high probability of being successful. Remember, we think in terms of probability. There's no certainty in trading. It's only probabilities, right? So thinking in terms of probability, looking at, the other indicators that I also look at as well. So I'm always looking at the 11 sectors that make up the S&P 500. So you got the XLK, XLV, which are the two big dogs that have the most impact or the most influence with respect to how the market moves. As you can see here, XLK is over 1% and XLV is just under 1%. So I'm not really concerned based upon those percentages that the market is going to move much higher from where it currently is, right? And so we can also look at the advanced declining indicator and see that it's definitely in positive territory. It's at 1,096. Basically, look at the difference between those stocks that are advancing minus those stocks that are declining on the New York Stock Exchange. And that has a major influence on how the SPX moves, right? And so obviously it's up. It seems to be tapering off at that 1,095, 1,100 level, right? And then we also have volume that's increasing as well. So I say all that to say that the market, definitely is gonna end up closing in positive territory. And so just based upon where it has been over the last few days, just looking at the last 4 days closing prices, the market hasn't done much at all. So as you can see here, if you look at the differential between the various market closing sessions, the market hasn't really done much at all. So we do have JP Morgan, well, the big banks, JP Morgan, Citi, I believe Wells Fargo, and another bank that's going to be reporting earnings tomorrow. So that definitely will have an impact on how the market moves tomorrow. But nevertheless, I feel pretty good about this position here on the call side, in spite of the fact that the price of the underlying SPX is increasing so steadily, right? It's increasing, but nevertheless, it's already up 35 points. As we can see here, XLK hasn't really increased that much. Normally when the market moves, when you see a really like a 1% move from the market, you'll see XLK over 3%, as well as XLV over 3%. So that's when you'll see a significant move in the market. But right now, the market is a little less than it's moved a little less than 1%. But I'll come back and give you guys an update to let you know how the position is doing. All right, guys, I'm back. So this is going to be a really interesting video because so the position that I had on at 41.45 and 41.55, as you can see here, had I stayed in it, my short strike at 41.45 would actually be in the money. So what I did was I decided to roll the position out. So the initial position, I actually took in a credit of 25 cents for each contract that I sold. I sold 5 contracts, so $125 is what I took in. Now, as you can see here, so that's conveyed there, right? So that was the first, that was the original position at 41.45 and 41.55, right? So I took in 25 cents. So now that I rolled it out, I rolled it from today out until April the 18th, right? Which is Tuesday. And I took in an extra 20 cents. So right now, my total credit is 45 cents for 5 contracts, right? So we do the math on that real quick. So 45 times 5. So it gives me a credit of $225. But you get an additional credit for actually rolling, right? So the position itself is currently sitting at 1,570 for a total credit. Now, if the position that I rolled to, which expires on April the 18th, if I'm able to stay in that for the entire time, then I'll actually get a little bit more than the 45 cents credit for each contract. But I have to, but the break even is if I'm able to close out this position for at least 45 cents, then I break even, there's no loss. And so the roll is actually, would have been actually worth it, right? If I'm able to close out for at least break even. But my intent, so right now, the SPX is up over 1.3%, which is a pretty significant move in one day, right? So that's one, little over 1% move. If I go back to looking at the closing prices over the last 4 days, so you can, we were pretty much done. We were pretty much due for an update, right? Because the last 2 days have been in the red. Although they weren't in the red by much, but they have been in the red. So, it's not surprising that we are that the SPX is up pretty significantly. So I had to roll out. So of course my put position is well out of the money. So I'll reap that. I'll reap that credit of $175. But what I'm thinking about doing here is because this SPX is in overbought territory. So as you can see here on the RSI, it's extremely overbought. Well, it was extremely overbought. It's coming down now. So what I'm going to do is I'm going to try to get some credit on the call side, just as this thing is pulling back. I think I'm going to wait. Because it might reverse and go back up. But as you can see, this thing has been in oversold territory pretty much ever since around 1:40. And so right now is actually 2:23 p.m. So close to an hour, this thing has been in overbought territory. Overbought territory. As we can see here, the Awesome Oscillator is beginning to show that the momentum is actually shifting, right? So as we can see here, it was showing that the momentum was going up. So now we see the red candlestick, if you will. Not necessarily a candlestick, but nevertheless, it's a red market here is showing that the momentum is beginning to reverse. It looks like the RSI is beginning to go back up. So yeah, I'm gonna continue to video to record this particular trade because I think it'll be a good learning experience for those folks who oftentimes are in a position where where the underlying is actually going against you, and you don't know what to do. And so oftentimes it really behooves you or benefits you if you actually roll. And sometimes you want to make a decision sooner than later, right? Because the sooner you make that decision to roll, the better the credit you can receive, and also the better you are to position your new position, right, when you do roll. So again, I'm going to continue to record this trade so that you guys can can see the ultimate outcome. All right, guys, I'm back. I want to give you guys an update. So today is Friday, April the 14th. It is approximately 10:13 a.m. Eastern Standard Time. So just to recap, so the position that I was initially in on yesterday, I was at 40. So I sold the 41.45, right? And I bought the 41.55. Okay, so obviously, if you watched the market yesterday, you know that the market started to pump later in the day, and I had to roll out my vertical call credit spread that I took in 25 cents for. So I took in 25 cents for this spread, and I sold 5 contracts. So I had to roll it out from yesterday's expiration date, right, to Tuesday's expiration date, which is April the 18th. And I took in an additional 20 cents. So right now, I have received 45 cents in total for that original position as well as the rolled position, right? So as you can see, I'm down right now $1,075. But prior to the market closing yesterday on the 13th, I put on a vertical put credit spread at 40.85 and 40.75, right? So I call this trading the swing or trading the post. In other words, I have this longer term position, or not a long-term position, but a longer term position on, right? That expires on April the 18th. And so what I'm going to do is essentially I'm just going to trade on the put side, because I already have something on the call side, and so that call position is a longer term position, and so I'm just going to trade that. I'm just going to trade on the put side, and any pullback that I get from the market, although I may start to my P&L will actually go into the red on the put side, considering that I have this longer term position on the call side, and the credit is actually bigger than 45 times the number of contracts that I sold. So hopefully you're tracking. So 45 times 5. Let me just pull my calculator over here. I won't pull over. So 45 times 5 gives you 225 basically, right? But nevertheless, because I rolled it, the credit is actually higher than 225. So if we look at the position itself, it's about roughly around 1,400, because what you see here is the roll position as well as this vertical put spread that I put on for $225, and then this vertical call spread that I put on for $150. So if we look at, let's just do the math right quick. So 225 plus 150, right? So that gives me 375. So if we subtract 375 from 1770, we get 1395. So essentially, this roll position is worth $13.95, although I can break even if I'm able to buy it back for 45 cents, right? Because that's my original, that's the credit that I took in for the original position as well as the roll position is 45 cents. So if I can get out at 45, then I break even. But right now, as you can see here, it's telling me that if I wanted to get out now, it would cost me $270. I'm going to lose, right? And my loss would be $11.25. So hopefully you're tracking. All right, so now that I have that longer term position on that expires on Tuesday, what I'm going to do is I'm going to focus on bringing in as much credit as possible until that expiration date, until the expiration date on April the 18th. All right, so hopefully you're tracking. Excuse me, I have a little has some phlegm going on, but yeah. So the market ran up yesterday. It closed. What was the? Just looking. So it closed. It closed up 1.33% yesterday, right? So I expect a slight pullback or for it to be slightly up because we were due for an up day anyway. I mean, we had 2 red days, so we were due for an up day. Let me bring this back up. All right, so we were due for an up day. Yeah. So, but I suspect that I don't think it's gonna. It's definitely not going to. Well, I won't say definitely, but there's a high probability that these 2 positions should work out fine today. So that'll be 375 that I'll take in, right? And just looking at the chart here, so the 4085 is well below my 1% level, and the trade that I put on this morning, the vertical call credit spread that I put on this morning, it's above the 1% level on the upside. So I'm below the 1% level on the downside as well as the upside. So I'm feeling good about these 2 positions. But again, as I mentioned before, I don't like rolling on the call side, but really I had no choice yesterday. And considering that the market was pushing pretty significantly, I figured if I rolled, giving myself an opportunity to actually come out profitable or break even, and also understanding that there's no major news that's on the horizon. So we just had the last metric that the last BLS metric that came out yesterday, I believe, the producer price index or indicator. So yeah, so the producer price index, right? So the producer price index is it's analogous to the CPI, the consumer price index, but it looks at producers versus consumers, right? And so that came out yesterday. Obviously it pulled back, so it was a positive, and that's one of the reasons why the market actually had an update yesterday. So I say all that to say that again, just looking at this, so this here is the vertical call credit spread that I put on this morning. I'm up $60 right now. I took in 25 cents for each contract, so I sold 6 contracts. And on this vertical put credit spread, I'm up $140 for the 5 contracts that I sold at 45 cents or $45 per piece per contract. All right, so yeah, so that's the update. I'll come back later on today to give you guys another update to let you know how these positions are doing, and also to look at where the longer term position is with regard to the P&L. All right, guys, so I'm back. So it's approximately 11:40 a.m. I want to show you, well, here's the position here. So as you can see, the position, my P&L is constantly increasing because the price of the underlying being SPX is coming down, right? And so as it's coming down, the position that I rolled out to April the 18th is beginning to lose value. Thus, it's causing my P&L to increase, and also the positions the one that I put on yesterday right before the market closed. As you can see here, that position is here. So as you can see, I am at $150 thus far. 150 of the 225, right? So I can actually close this out now if I wanted to, but I think I'm gonna actually probably gonna close it out, and because the market is coming down a bit. And then the vertical call spread that I put on is also decreasing in value, which means that it's actually causing my P&L to increase in value. Right, so as you can see here on that vertical call position, I'm actually at $75. So yeah, so things are working out. I could probably close this out now. I can actually close all three positions out, right? All three positions. So this position, let me change the color here so you guys can see this better. So if I was to close out this position, I would lose essentially $500. If I close out this position here, I would walk away with 160. And if I close out this position here, I'll walk away with 75. So the net loss would actually be $265, right? So if I was to close out all three positions. So that's the benefit of rolling. You know, sometimes you gotta roll to live, to fight another day. But also it's extremely important that you're always aware of what news is on the horizon, because if you're rolling out to, you know, a day or two out and there's news within that 2-day time frame that could potentially impact your position, your rolled position, then the question becomes, do you actually want to roll? Right? So it's always important to have market awareness. So you want to know what news is on the horizon, you know, for the entire week and also maybe the next week, you know, so just in case you had to roll, you can decide whether or not you want to roll, how far out you want to roll, or if it just makes sense to take the hit and, you know, take the small loss and just close out the position quickly. You know, so these are the decisions you have to make. But luckily, when you are trading credit spreads, you know, the price action is not happening. It's not happening. It's not happening fast enough to where you have to make a quick decision, right? So so the price of SPX sort of grinds, right? And so it gives you, if it's grinding towards your position, it's going against you. So it gives you time to really make a decision. So yeah, but I'm gonna stay in. Of course, I'm gonna stay in the call, the vertical call spread. And I don't, you know, I'm pretty confident that the vertical put spread will expire out of the money as well. But definitely, I'm happy to see that the price, that the loss that I initially had, where it was at $1,000, a little over 1,000, has come down significantly now to you know, to be 440. So I can deal with that. I can deal with the 440 loss, but the overall loss would be 215. You know, because again, I got you know, a profit here and a profit here. So I'm gonna come back and give you guys another update, probably near the end of the close of the market today, and let you know how it's going. All right, guys, so a quick update. It's approximately 12:17 p.m. Let me pull up my pointer here. So I'm looking to close out this position here. Right, so as you can see here, my my order is working. So I'm looking to close this out for 10 cents, right? So I got into the position for 45 cents. 45 cents, I sold five contracts. Basically, that's $225. But I'm looking to just get out right now and walk away with the 175. I'm gonna keep the vertical call credit spread on, of course, where I sold you know, 6 contracts at 25 cents or $25 each. So I'm gonna keep that on, and then as you can see here, my position that I rolled has come down nicely. So I'm only looking at a loss of $350 right now. So we look at the position as it stands. So of the 1,770, I'm at $1,180, but it's constantly oscillating there. So But yeah, I want to get out this position here though, on the put side. So hopefully I can get filled at 10 cents. As you can see here, the activity. This is my requirement or my limit order. And this is what the market is willing to offer. So I'm not sure why I'm not getting filled, but sometimes you just gotta let it sit for a while and marinate, and eventually you'll get filled. But so that's my update. I'll come back and maybe again post to the market to the end of the market today, end of the session. I'll come back and give you guys the last update. I might even decide to close out the roll position that expires on April the 18th and just take that small loss of 375, which when you add these two profits in, overall be $120, $125. So nothing significant. All right, quick update. So it's 12:25. So I was able to close out that vertical put credit spread for 10 cents. So as opposed to walking away with 225, I'm actually walking away with 225 minus 50. So I closed it out for 10 cents. I sold 5 contracts, so 5 times 10 is 50. So that's $50 that I had to pay to close out the position. So I'm walking away with, instead of 225, 175. But that's fine. That's fine. You can never lose money by taking profits early. Trust me. So the market is continuing to come down in value. So I didn't want to risk it. So figured I would just accept the 175 and keep it moving. All right, guys, I'm back. So another update. So as we can see here, so it's 12:47, right? So remember, I closed out this vertical put credit spread that I put on yesterday for 45 cents. I closed it out for 10 cents. And then as you can see here, the position that I rolled from yesterday to April the 18th, it has come down pretty significantly. So if I was to close it out now, I would only be looking at a loss of $175, which is nothing, right? So I'm really considering just closing this trade out because you never know what could happen between now and Tuesday, right? Although there's no major reports that are coming out between now and Tuesday, you just never know. So I think I'm gonna run with the 1145. Looking now, it's down to 160. And if we look at the market internals, right, we can see that anytime you see volume just plummeting like that, it's a slow grind all day. But yeah, the market just continues to drop, right? So we had a run up yesterday. Today folks taking profits off the table, and as you can see, the market is plummeting. So yeah, I think I'm gonna really consider taking that position off that expires on April the 18th. As you can see here, it's significantly there's a significant distance between the price of the underlying and also my position. But again, we're talking about the expiration date of Tuesday, and today is Friday, right? So, and now we're down to 160. So I'm gonna go ahead and close this out, guys. I'm just going to accept that $150 loss. I probably should wait because it looks like the market is going to continue to plummet, but it may bounce at some point. As we can see here, the awesome oscillator on the 1-minute chart is beginning to show a reverse in momentum. So I think I'm gonna go ahead and just close that position out. Take that 175. So it's this one here. Close that out. Close that out. See if I get filled. Hopefully I should get filled. Right, and so if I get filled on that, then the only position I'll have left is this vertical call credit spread that's way out of the money. You know, so let's look at the activity, see what's going on with, yeah, so I'm looking to close it out at 80, and well, right now we're matching. So, and here is the actual price. So as you can see here, this is the so this here is my break-even price, right? The 45 cents. But of course, because it's above 45 cents, then that means I'm gonna walk away with a small loss of 190, at least at this point. So I should be getting filled on this position. There we go. I'm out. Great. So I'm out. So as you can see here, the loss is only, pull out my pointer. So the loss is only it's only 175, right? That's pittance. Yeah, that's pittance. So I've recovered from a potential loss of over $1,000 to a loss of $175. So that's the benefit of rolling. Sometimes you got to roll in order to live and fight another day, right? And so as you can see here, the position I have left is the vertical call credit spread, and so I'm at 100% on that. So yeah, guys, so hopefully you guys enjoyed these video segments. Hopefully you learned something. Yeah, so, you know, oftentimes, again, I don't like to roll on the call side, but considering that the last Bureau of Labor Statistics report came out yesterday with the producer price index, nothing on the horizon for the next few days. You know, the next FOMC meeting isn't until May the 3rd. So yeah, so I figured, you know, roll on the call side, although I don't like to roll, it was definitely necessary yesterday because I could have taken a major loss, a major hit. Yeah, as a matter of fact, so the hit would have probably been like maybe $500 or $600. Because I was at 41.40, I was at 41.45, and the market closed at, where did the market close? The market closed at 41.46 and some change. Yeah, it closed at 41.46.22. You know, so it would have been about a $500 or $600 loss. But so that's compared to the actual $175 loss. So yeah, so that'll wrap up these video segments. So again, hopefully you guys learned something. And again, if you have any questions about options, definitely feel free to email me at info@cubicleinvesting.com.